John, thank you very much for coming to the conference, and I'm much looking forward to your talk tomorrow, as I'm sure everyone else is. But perhaps in anticipation of that, could you offer some thoughts on the productivity slowdown, what we've been calling the productivity puzzle, and in particular perhaps why it's been so pervasive internationally, whereas after previous crises, some countries have had productivity problems and others haven't?
One of the challenges in this is countries are heterogeneous. Now, as you're saying, everyone has had a slow productivity growth and, in fact, disappointing output recoveries since the Great Recession. So if I start with the U.S., which is where I've worked a lot, productivity growth clearly slowed down before the Great Recession. If you're looking at why has output growth been slow during the recovery since 2009, since when the Great Recession ended, it's two things. One is slow growth of the labor force, because with an aging population, labor force is growing more slowly than historically, and modest productivity growth. Those two things completely can explain the slow pace of output growth. But productivity growth is not slow relative to history. Productivity growth since 2004 has been the same as it was in the United States, the same as it was in the 70s, 80s, and early 90s. Then the US had a productivity acceleration that lasted maybe a decade, from the mid-90s to the mid-2000s, associated with exceptional gains from information technology. Well, those gains seem to have run their course by 2004, 2005, or thereabouts. And so in the US, I would look at this and say, it's a return to normal productivity growth. Mm. Now, the Great Recession affects the dynamics of labor productivity somewhat. During the recession, low-skilled workers lost jobs, so the people who were working were the cream of the crop. In the past 6-7 years, many of those people have been hired back. So the quality of the labor force has added less to labor productivity. And another issue is firms came out of the Great Recession with a lot of capital. What they didn't have was demand. So they haven't needed to invest at a pace that you would have historically seen. So capital added, in an accounting sense, added a lot to growth during and then right after the Great Recession, because the workers who were still working had a lot of capital. So I would look at the average since about 2004, and it looks kind of like a return to normal for productivity growth. We've seen that pace of productivity growth before. What we haven't seen is that pace of productivity growth combined with the demographics of an aging population and slower growth of the working age population. When you turn to other countries, one of the things that really is striking to me is not so much the Great Recession, but the fact that productivity has been slow, has been falling short of the U.S. pace, for 20 to 25 years. This is especially true, I think, of continental Europe or maybe Japan, where any number of papers 15 years ago were talking about, why can't Europe get the same gains from information technology that the United States has? The typical story of the conventional wisdom, which sounds right to me, is it was more difficult to reorganize in Europe because of product and labor market rigidities. And that's made it harder to adjust to some really major structural changes in the global economy. Information technology, and of course the rise of China as two major structural changes. The UK is a little different, where it was catching up to the US, or at least moving parallel with the US up until close to the Great Recession. And since then, it's been growing much more modestly.
Well, of course, with our own experience, I think of the advanced economies, we've had one of the largest declines in productivity growth compared with the pre-crisis period. So if you look at what's just described as a puzzle for anywhere else is a really big puzzle for Britain. But I was interested by what you said about modest population growth or labour force growth in the United States, because of course in Germany and in Japan the labour force is declining now, and I remember, well, it was a while ago, I forget the exact period, looking at the growth in output per person of working age
Yeah.
between 2010 and say 2015. And I think the two top performers were Japan and Germany of the advanced economy, of the big advanced economies. So perhaps we need to pay more attention to what's going on, with the labour force when we start to compare, different countries and at least their overall growth performance.
That's right. I think one often looks at, say, at Japan and thinks, well, they've really barely grown for 20 years with these lost decades, but GDP per hour worked has not been that far short of the US pace. What's been really striking is that hours worked has been going down because the working age population peaked in 1995. So they've had a shrinking labor force for decades. Of course, working age population doesn't translate perfectly into labor force, but it's a rough proxy. It's obviously a major factor. Older people work, and even within working age, there's labor participation decisions of women are an important margin, which at times has been an important driver of growth beyond just the population, but it's a big factor. One of the things has happened at the same time we got the Great Recession, is we got this big, almost demographic transition. That the leading edge of the baby boom generation hit 60 in 2007 as a typical starting date for the baby boom, and hit 65 in 2012. And so there's been a big slowdown in the growth rate of the working age population that's visible in the statistics. 0.75% to 1%, depending on what country and years you're looking at. When you look at either in the U.S. or if you look at Europe. So in terms of the overall GDP numbers, that's a big factor in that headline number.
Yes, no, I mean, I can certainly see that, and as you said, it's affecting different countries at different times, but it is really affecting everyone. But if we focus then, particularly on the productivity issue, because the labour force growth is determined, at least to a substantial extent, by historic demographic experience, and isn't going to change in the short term. Do you think there are policies that countries could adopt that would lead to faster growth in productivity again, particularly those that are lagging behind the United States, or should we just think that, as in Britain, lots of policies have been tried and none of them have worked?
It's very challenging to get policies that work reliably. Conceptually, I think of this with two issues, or two conceptual factors. One is what's going on at the frontier, and the second is convergence. Some countries start far from the frontier and then they grow fast, potentially, and then they can, so if they're far from the frontier, they have the potential to grow fast. But most countries that are far from the frontier, typically we take the U.S. as the frontier, although it's not always clear that that's the right, that in every industry that would be the right benchmark. But most countries don't converge to the frontier. And I gave you an example of Japan a minute ago, that it was growing extraordinarily fast after World War II up to 1990, 95. That has been running parallel to the U.S., but at a level of productivity that, depending which numbers you look at, might be 65 to 70% of the U.S. level.
Yeah.
By most numbers, the UK is still, about 80, 85% of the US level. So that suggests there's a possibility that and so the hope would be the structural reforms in labor markets and product markets might be the sorts of things that would get you on that convergence path. The challenge is that it's very hard to sequence these things. It's very hard to really see the results in any quick time period. So to a large degree, this remains a mystery. At the frontier, I mean, the popular, one popular strand of thought, say in some circles in Washington, would be what you need is regulatory reforms and reduce regulation and cut taxes. But if I look at the US time series data, in the 80s, there was a big reduction in taxes and in regulation. Productivity growth stayed pretty low. In the 90s, when the Clinton administration came in, they tried to undo many of those things. They raised taxes and they added a number of regulations. And a few years later, there was an explosion in productivity growth. You look in the early 2000s, with a new administration, cut taxes and tried to cut some of the Clinton regulations. And a few years after that, productivity growth slowed down. So it's not that I think that the regulation and taxes don't matter. I mean, they certainly can. And when you look across countries, it certainly looks, you can see examples where regulations clearly are getting in the way of growth. But other things matter potentially more. In the US case, it was the fact that there have been ideas percolating along with information technology and companies learning how to use it, and then a lot of things just came together, as well as, of course, with the internet, there was an explosion of opportunities and every business was reorganizing to take advantage of it. So those are things that were very hard to predict before the fact. You could point to these things and say, oh, this could, there's a lot of opportunity here. But of course, as Bob Solow famously wrote in 1987, you see the computer age everywhere except in the productivity statistics. So even in 87, you saw the opportunities, you saw the computers, everything, you saw the transformation happening everywhere. But the actual progress in terms of increasing output per hour was very slow.
What would you make of perhaps an alternative explanation that the United States stays on the frontier because there's more space for doing things, and does that increase productivity the way we measure it? That we aren't counting the input from land properly?
Well, there's certainly an attempt to measure the input from land, but those measures, as you know, are not necessarily that reliable. Yeah. I mean, the most productive places are typically cities. Where you're trying to put more and more activity in a small area, and a lot of that is because you need to bring people the benefits of having people close together, suppliers close. The flow of ideas is easier. So it's not the first thing I would point to or that I look at.